Let's talk about another type of common business form, franchises. A franchise can be described as an arrangement in which a seller, the franchisor, sells to a buyer, the franchisee, the right to sell or distribute products or services that are made available through or by the franchisor and use the franchisor's trademark and marketing plan. Franchises are unique in that they can be carried out under any of the three business structures we discussed, as a sole proprietor, as a partnership, or as a corporation. While franchises are not a specific form of business organization in the sense of their legal structure, in that any franchise operation can be carried out as a proprietorship, partnership, or corporation, they have become such a pervasive part of the business environment that they require specific mention. There are a number of advantages to buying a franchise. Buying a proven franchise usually means that both the borrower's and the creditor's risks are lower than in a non-franchise situation, particularly where the franchise purchase is the franchisee's first experience as a business owner. This is because, typically, the franchisee will not only receive necessary training from the franchisor, but will also operate within proven operating guidelines, thus lowering some of the operational risk the inexperienced business owner may otherwise face. Further, the business will operate under an established name or trademark with a product or service that is familiar to the public, leading to a more reasonable prospect of success. The franchisee shouldn't need to spend as much time, effort, and money to establish market recognition. A franchise business may also require less working capital than a similar non-franchised business. The franchisee may immediately be able to sell a proven product or service with established market acceptance and therefore may need fewer financial resources to cover expenses until a reasonable sales volume is generated. If the franchise of a large national chain is being acquired, the franchisee typically benefits from reduced costs of purchases due to the chain's large volume of purchases. Plus, the franchisee also benefits from the extensive national and regional promotional activities of a large franchisor. Both of these items help relieve typical cash flow pressures a business otherwise faces. There are also a number of disadvantages to franchises. As a general rule, a franchise is only as good as the franchisor. When buying a franchise business, there's usually an agreement outlining the responsibilities and right to the franchisor and the franchisee. These terms can be both restrictive and costly, so it's critical that a credit analyst review them very carefully, as there could be conditions that affect the strength of the credit proposal. For example, the franchisor could have prior claim on the equipment or inventory of the borrower. What that means is we wouldn't be able to take those items as security to protect our loan. Personal guarantees provided by the franchisee to the franchisor may also have a significant impact on the borrower's capacity to honor a guarantee to a creditor. This may be more concerning where the franchise is not well known and doesn't yet have a strong network or presence. The franchise agreement may also stipulate that the franchisee must personally run the business and not leave its operations to a hired manager. Given the difficulties that absentee or inattentive management can create in a business, this rule can be viewed as a positive feature by a creditor. Normally, a franchise agreement will state that the franchisor decision is final in any disagreement between the franchisee and the franchisor. This may be seen as an infringement on the franchisee's operational freedom, and in some cases may prove to be a real disadvantage. However, Consistency and uniformity are key reasons for the success of franchise businesses. And from the creditor's perspective, the franchisor's control may prevent what might otherwise be poor business decisions. Finally, the existence of sales quotas, royalties, service fees, and minimum supply quantities will likely have an impact on profits. Restrictions on price adjustments may affect both volume and profits. It's also possible that the franchisor may decide to raise the price structure, a situation which the local franchisee may not see as desirable given local competitive conditions. Nonetheless, the purchaser of a franchise has to be aware that uniformity and consistency is the name of the game in the franchise business. One final item that a credit analyst should pay attention to relates to property, plant, and equipment, which lenders typically take for security. If the franchisor is the head lessee under a lease agreement, this may, from the creditor's perspective, put the franchisor in control over the premises and therefore the collateral located there, a situation which is undesirable to a creditor, because it's the franchisee that we're lending to. Here are just some examples of well-known international franchises. 4 of them, McDonald's, Burger King, Subway, and KFC, are fast food chains. Marriott is a franchise made up of hotels, and 7-Eleven is a convenience store franchise.